Hello and welcome to the UCI Beal Applied Innovations VC Speaker Series. It's our webinar featuring conversations with VCs and investors. Our goal for this webinar series is to continue to connect the Southern California innovation ecosystem with the experts and the resources that will help entrepreneurs and founders navigate the current crisis and thrive in the recovery that we're sure is ahead. For today's webinar, we're honored to have with us Brian Mesic, the general partner and founder of Ankona Capital. It's a relatively new VC fund, but it has a pretty experienced team, lots of people with Southern California experience, and I'm sure you're going to enjoy meeting them. But before we get going, I'd like to acknowledge and thank our sponsor for the VC Speaker Series, Kenobi Martins. They're consistently ranked as one of the top intellectual property firms in the nation and worldwide. Kenobi Martins has close to 275 lawyers and scientists and dedicates its practice to all aspects of intellectual property and technology law, including litigation. The firm is headquartered in Orange County, and we're very fortunate at UCI Beal Applied Innovation to have Kenobi as strong supporters of our mission and of the VC Speaker Series. More information about the firm can be found at www.kenobi.com. So a few webinar details for today's event. So unlike the regular Zoom meetings, you can't unmute yourself on this and you can't turn on your video. So if you have questions, please type them into the Q&A box, not the chat box. So I'll moderate those and we'll ask those questions throughout the discussion if they're appropriate to what we're talking about, or we'll touch on them at the end. And after the discussion portion of the webinar ends, we're going to keep the Zoom webinar open, and Brian and I will type in some private answers. If some of you have some very specific questions, we'll answer those in the Q&A box then. So I think with that, Brian, if you can, why don't you join us now? And Brian, we can see you.
I am, here we go. All right.
There we are.
Hey, Luis, how are you?
Good, how are you? Good to see you.
Good to see you too.
Well, listen, very much appreciate you taking the time to join us. I think it's, you got an interesting story. I've enjoyed kind of learning more about it as we've gotten ready for this. But, before we get going, I'd like to give our audience a little bit of sense of, our guest and kind of who you are and where you've been. So why don't you tell us a little bit about, where you're from, where did you grow up?
I grew up right here in Palos Verdes. So I'm a local South Bay Palos Verdes guy. My father was a defense analyst at the RAND Corporation, so sort of a pseudo-academic. Yeah. And my mom left her career in teaching to be a mom. So I grew up in a little house in Palos Verdes and grew up right here in the South Bay. I've been here pretty much my whole life.
Okay, what high school there in the South Bay or Palos Verdes?
Back at the time, it was Rolling Hills High School, but it's consolidated now down to Peninsula High.
Oh, I didn't know that. Yeah, you're kind of familiar. I went to college with a lot of kids from the South Bay, so I think I'm kind of familiar with that. So, and then you went to Occidental College, kind of kept it here in Southern California. When I think of Occidental, I always think of like politicians, Jack Kemp or Barack Obama. So you weren't in politics back in Oxy, were you?
No. And Jack Kemp, yeah, I remember him, and of course Barack Obama, who did not graduate from Oxy, but he spent a couple of years there. I went there for their science program. I was pre-med from the time I was a little kid.
Oh, cool.
I wanted to be a doctor, and actually studied biology and was on the pre-med path up until the night before the MCATs, and had a revelation and decided to choose a different course.
Yeah, that's. I guess you didn't have to suffer through those 6 hours or whatever. No, the MCATs are 2 days, aren't they?
I don't even remember, but I felt unprepared. I was losing conviction on being a doctor, and yeah, made I think the right choice.
Okay, good. I'm glad you did. So, and then after that, after you graduated from Oxy, you worked for McKinsey & Company. That's a kind of a nice first job out of college. So tell us about that experience.
Actually, my first job out of college was at the Prudential in Woodland Hills.
Okay.
And I worked for their group insurance department as a product manager. I was building enterprise software applications. I built a client server, customer support tool, built some underwriting database applications, built some multimedia applications for sales enablement. And the last thing I did in '95 was I bought a Silicon Graphics workstation, and I wrote the first internet strategy for the Prudential, and didn't stick around long enough to get that off the ground. And I went to business school. I went to Dartmouth Business School, Tuck, back on the East Coast.
Okay. All right. Yeah. So I'm sorry about that. I got
Oh,
that
it's okay.
there.
It's okay.
So from Tuck, you joined McKinsey though.
I did. I was a summer associate between my first and second year, and then joined McKinsey full-time in the LA office. It was just a great experience.
Oh, good. It's good that you're also able to get back to Southern California into LA from there. So
it was, and McKinsey is really the first place. McKinsey is an amazing place, and really the first experience I had understanding the importance of culture. McKinsey does a really good job screening and then developing its people to all have this McKinsey way of doing things, and they do a remarkably good job at it. And the second incredible thing about McKinsey is the people, and that continues to be one of my strongest networks. Just as a side note, when I was a summer associate there, my summer activities coordinator, the one responsible for programming my social calendar, was Cheryl Sandberg. So just some remarkably good people. Dennis Woodside was there in my class. So just great, really amazing people.
No kidding. So, and then from there you jump to venture, but I want to pause there for a second because, a lot of people ask me, in my role here at UCI, they ask me for advice on how to get into venture. So literally just last Friday, I was on the call with a UCI undergrad and asking that. And I actually said, there was kind of a traditional path, kind of McKinsey or Bain consulting, and then jump to VC from there. And I said, that's at least an identifiable path. I'm not so sure if it still applies, but anyway, so let's just tackle that one now. When you're asked, Brian, I'm in college or I'm business school and I'd like to get into venture. What do you tell young people starting their careers?
So I bet there still is a path from McKinsey, and a lot of my colleagues did go on to venture firms. So Byron Dieter at Bessemer was in my office in LA. Venki Ganesan I worked with at Menlo in my office in LA. And there was, I think, sort of an easier path back then. And I still think there's probably a path to the bigger firms through McKinsey and Bain and places like that. But a lot of the action in the past 5 or 6 years has been with smaller firms. There have been 1,000 firms started over the past 5 years with an average of 60 million under management. I don't think they're hiring out of McKinsey. So,
right.
It really depends on what you're aspiring to. The bigger firms and the private equity-ish firms, I think it probably is still a decent path. But the more common path, and the advice I give to people that want to get into this, is to get some entrepreneurial experience, get some operations experience.
Yeah.
And the real truth, it's very hard to find a role. It just takes a lot of hustle and a lot of work. The best path to being a venture capitalist is to raise your own fund, and that's a whole different, that's a whole different story. But that really is the best path. It ain't easy.
Yeah.
That's
yeah. What some of the advice that I've given, and I've kind of settled in on it, is look, like you said, you could try to raise your own fund. Low probability outcome because it's just so challenging. We're going to talk about that. Then the other one is sometimes some young people like, well, I'll start a firm and I'll get VC money and grow it. And then when I do a terrific exit, then I'll join. Great opportunity. And that could work too. Also a low probability outcome. So, I tell people, look, be open to opportunities, but don't think about startups that are already funded. So if they're already funded, get into that. Learn what a startup is like from a venture-backed funded startup perspective. Learn the cadence of that. Learn about how you need to be capital efficient and those types of things. So you'll actually get some experience of being in a firm. So, and that's maybe less of a, kind of low probability outcome. It's got a higher probability outcome that you're gonna do something. So I think that's a good experience as well. Keep an eye on who's being funded, who's expanding their team, and see if you can join a startup that's venture-backed.
Yeah, that, or, we will hire an associate in Q1, and, we will look for somebody that has demonstrated interest in software. So these are, we'll look for people that like what we do.
Yeah.
We'll look for folks that have some experience probably in modeling or banking so that they can take on some of the financial diligence work. And people that are presentable as faces of the firm to go out and represent Ankona at events and to work with entrepreneurs. And so you can develop, whether you're at a startup or trying to get an entry-level position at a firm, you can develop your brand. And it's not hard to stand out because a lot of people say they want to work in venture, but don't really demonstrate any of the passion that we'll look for or some of the skills that we'll look to bring on board. And it is also something that's just so unpredictable. You have to be prepared and just network and be ready to jump, because there's no, unlike getting into banking or anything else, there's no annual classes typically, and spots are rare.
Right, exactly. Okay, so back to your career. So then you got into venture with Anthem Ventures, is that correct? Okay, so yeah, tell us about Anthem Ventures. Tell us about the firm, kind of who founded it, and what you did there.
So I left McKinsey in 2000 when all my colleagues were going off and going to places like Google and other places at the time, and I quit, really not knowing what would happen. And happened to be at the right place at the right time when a new firm called Anthem was getting off the ground. There was a founder there, Bill Woodward, and another guy, Todd, and I convinced them that I knew about enterprise software because of what I had done at the Prudential. And so we got the fund off the ground, and we got ready to go just before the dot-com bust happened. And so we were sitting around the table with a fresh pool of capital, no bad investments, and decided it was a pretty good time to be in business as a new venture fund. So nobody else was making investments. And we went back to what we thought the roots of venture capital were all about. We stayed away from e-commerce. We went back to really a lot of hard technology commercialization projects out of places like Caltech and UCLA and USC and places like that. And we did that well. Despite my presenting myself as an enterprise software guy, probably my first half a dozen investments were all semiconductor investments.
Oh, yeah.
But we did well. We were usually first institutional money coming in. The typical founding team was a couple postdoc students at Caltech and a professor who had spent a bunch of years and a bunch of DARPA money building a prototype, and we took them from the lab to the fab, and we did that well.
Oh, good. So what are some of the investments you made at Anthem? Any nice exits, any successes you can tell us about there?
Well, the one that everybody's probably heard of is Android. We were the only institutional investor in Android before Google bought them. But I want to say we made $7,000 on that investment. So we had a Series A term sheet signed with Andy Rubin, and we're bridging the company to the Series A when Google bought them. So we made a little bit of interest money on our $100,000 bridge loan. So, oh
my goodness, that's how you made 7,000. Yeah, I knew the number because you mentioned it, but I didn't know the mechanics of it. Okay.
7,000.
Oh wow.
My first couple of investments were semiconductor companies in San Diego, RF Magic and Entropic Communications.
Okay.
They merged and went public.
Mm-hmm.
Made two investments in Orange County, one called Solar Flare Communications that was just acquired by Xilinx last year. It took 15 years, but we got that one acquired, and a security software company called Intercept that was just bought last year as well.
Yeah.
Another named one that folks have probably heard of is TrueCar. We were seed investors in TrueCar. I sat on the board for a while. That was a crazy journey, but I got up to a nice market cap. It's come back from that nice market cap.
Yeah.
Actually, probably the best investment in terms of return, multiple, and IRR is a little one nobody's heard of called Planet ATE in San Diego. Super capital efficient. I think we put in $3 million, probably pulled a 5 or 6x return in 3 years, never had to raise much money. And
nice.
It doesn't move the needle in terms of scale, but we learned some lessons there about the importance of being capital efficient and taking the right exit when it presents itself.
Yeah. No, you like Entropic, TrueCar, Android, where some of the Solar Flare. You mentioned, there's quite a legacy here of Southern California companies for folks like me that have been in here for 15, 20 years. Yeah, those are a lot of the companies going all the way back to like you said, to 2000 that have made it. So it's great that you've seen that. So you've probably seen also some failures along this. So tell us about one kind of lesson learned from Anthem, or maybe what did you learn from Bill Woodward? Bill is, I should say, Bill's a character and a smart guy. So what did you learn either from failures or from Bill?
So from Bill, it's interesting. I mean, this is building capability. I won't market myself as a highly, I think I'm a reasonably competent investor. I won't even say that I'm great, but it is no matter what a mentorship model, and Bill was my mentor early on. And I started at Anthem out of McKinsey, And at McKinsey, all you had to do was figure out the right answer. That was it. Job was done when you solved the problem. And that's the way I began to approach my work in venture. And the first thing Bill taught me is that doesn't matter. That's 25%. You actually have to go get stuff done. You have to make weather. You have to have an impact. You have to move a board. You have to sell a founder. You have to do all this stuff that you never really have to do at McKinsey. And that's exactly right. I mean, getting the right answer is just table stakes. But being an impactful investor is a completely different set of skills that I didn't have.
Yeah.
I didn't have any. I was an analyst. I figured out how to get to the right answers and solve problems, and that doesn't really make you a great investor.
Yeah, no, that's interesting. I think that'll tie into something, when you're talking about what you're doing with Ankona, I think that'll tie into it nicely there. So good.
Actually, all right. Well, one other thing I learned from that I still take to this day is sort of along those same lines. Never give up. I mean, we would get stuck, and I would be certain that we've exhausted every possibility to fix something, because everything winds up looking over the edge of a cliff at some point. And he never accepted that answer. He didn't have a better solution, but he just never accepted that what we had come up with for the answer or solution to something was all that we could do. And almost every time, despite fighting and disagreeing, we'd come up with something else. There's always something else to be done. When you think you're stuck, there's always something else. And every time, and it frustrated me to no end, it works. There's always something else to do.
Yeah.
Something else to do.
Good. Yeah, that's good advice out there. So, okay. So now Ankona. And then, one of the things that is interesting about Ankona is that based on where you're targeting, which is Series B, and we'll talk about that in more detail, of course, but there was a kind of a persistent and possibly true perception that Southern California and Orange County is a good place to get companies started and get angel, seed, Series A investment possibly, but that when you get to Series B, you've got to go elsewhere, probably the Bay Area, for the investment, and possibly even move the company up there. So kind of, do you buy into that perception? Was Ankona created to fill that opportunity gap? Do you see it then as an opportunity? How much is it true, and how much did it play into your design of where Ankona was going to invest?
I mean, that played a big role. When I decided to leave Anthem and start Ankona, a big reason was I was becoming a little disillusioned with the early stage investing model that Anthem was following. Back when we started Anthem, we could very predictably invest in a Series A round, get a product to market, get a little revenue, and bring in a follow-on Series B investor at a nice market. And that just gradually changed over the years. There became, and I think there's a couple factors. One, it just became much more capital efficient to build a company and a product. Mm-hmm. And there was an explosion of seed and Series A financing. So there was just a lot of activity at the Series A level. But when companies went out to raise Series Bs, it was just a lot tighter. It became harder to raise those Series Bs. The venture funds that we could rely on to do a Series B in a niche defense-focused semiconductor play 15 years ago, we wouldn't touch that today because it didn't have unicorn potential.
Right.
And so this unicorn bias in the venture world, combined with the increasing size of funds across both venture and growth equity, to us created this gap, the Series B gap. And I think that problem is universal, but it's particularly acute in Southern California. We've got a lot of really good seed and Series A funds. We've got a lot of bigger growth equity funds and private equity firms that will do invest in software companies. When they get to 10, 15, 20 million in revenue and need to raise 30 million, but not a lot in between. So it did, we were responding not specifically to a gap in Southern California, but to a general gap. But we do think it is particularly acute here in Southern California.
No, you're right. I mean, just you said there's a gap just in the industry. It strikes me that when you go to a private equity conference and you're walking around, and there's the ACG puts on a great one, their wine event where all the private equity firms kind of line up, and as you're sitting there chatting around, like, where do you start? And the answer you generally get is, we start at usually it's 20 million EBITDA, 50 million EBITDA. And then occasionally you'll talk to one 10 million EBITDA. And then you kind of scratch your head. So, wow, there's a lot of headroom between, kind of startup and 10 million EBITDA. So yeah, there's a big gap there, and it's great to have you guys fill it. So I teased it a little bit, and you have too, but let's actually talk about your criteria then. What do you focus on? And I will point out that, yeah, you and I had this discussion. Your website's almost crystal clear on it. So if anybody's gone to the website already, I apologize for being redundant. And if you don't catch this, go to the website because it's crystal clear. So tell us about your criteria and your focus.
So we invest in emerging growth stage B2B software companies. And we market ourselves as founder focused. We can talk a little bit about why that philosophy, why that matters to us. But really we're looking for companies that are past product market fit risk. We have a typical revenue minimum of 5 million. That's a little bit of a proxy for product market fit risk, but we're looking for companies that have identified a market with customers that love the product, with enough revenue history that we can dig in and really tease out the SaaS metrics that we want to see that are indicative of being ready for an investment in growth. And we're looking for companies where we see a capital efficient path to scale and profitability. And scale to us means 30 to 50 million in revenue. And we want to see companies get profitable. And we want to see our capital, or the round that we're in, have a good shot at taking the companies all the way. And we can talk about why we have that philosophy, but we are looking for capital efficient, smart growth in everything we do.
Yeah, so software business, B2B software, that's clear. 5 million ARR is a proxy for product market fit. How about round size, check size? What does that translate into? What does your model end up kind of spitting out in terms of what are the companies looking for at that point? I know you want to be capital efficient, so you're probably ruling out the $35 million rounds, but what does it mean kind of at the Series B round?
If there was an average, it would be a $15 million financing round.
Okay.
We will, and we are considering some smaller rounds. And part of what we're discovering, I think we've done a good job figuring out our own product market fit. We're a startup, like anything else. We are a startup. And I think over the past 9 months since we've been doing this, we have found our product market fit. And I think we'll dip a little earlier in some cases, but typically a $15 million financing, we can comfortably write a $5 million check from this fund, which is what we want to do. So we look for opportunities where we can put in 5 million. Mm-hmm. In our next fund, I think of this fund as our seed fund. When we raise our Series A, which would be the next fund, I hope we can scale up to $10 million initial checks.
Yeah. Oh shoot, I had my question and I forgot it. It'll come back to me. So you obviously you got it started. So how did Ankona kind of come together? And listen, it wasn't easy. You've been through some challenges. So why don't you share some of those?
It was not easy. And if anybody aspires to raise a fund, we could do a separate webinar on lessons I learned doing this. I knew from the start it would not be easy. Turns out to be even harder than I thought. Even forgetting about some of the personal things that happened that I'll go into, but I left Anthem in mid-2017, really started fundraising hard for Ankona in early 2018, and we got the first close of the fund done August 2019. So it really took 2 years to get to a first close, and we're still a quarter away from a final close. So it's been a really, really long journey. We thought we had everything we needed to raise a $150 million institutional fund, and what investors look for is a team with a track record together that's consistent with the strategy that they're using moving forward, and also a history of working together, because the biggest risk in a new firm is cramming together a bunch of people with strong personalities and having the thing blow up. So we had all that. Incredibly, both the partners that I started Ankona with passed away in the past year, which is both tragic personally and forced us as a firm to change our fundraising strategy. So we're on a new path. So we're a new team essentially as of January.
Yeah, that must have been hard, kind of both on. I mean, no, it just the words don't match that. So you're starting a new fund and with three people and two of them pass away, and I imagine unexpectedly.
unexpectedly. And you know, the challenge with each of them was they were personally friends of mine. But the first was killed a week before we did the first close, and so we were middle of a close, so there was no time to grieve. I mean, it had to keep going. And the second one in January, we had investors in a portfolio, so the business had to keep going. But you know, this whole process has been incredibly humbling. You know, I spent 17 years investing without ever having really been in the trenches to start something. And I sort of feel like I've earned my founder stripes now. Struggled to build a team to keep it going. It's been a journey.
Did you consider throwing in the towel?
When the second founder passed away, there was really one path forward. And if that didn't work, might have had to. But fortunately that worked, and it's been working really, really well.
Wow. Okay. So you were able to build a new team from that. So tell us about your new team. Tell us about the other partners in the fund and kind of how it came together.
So a big part of our thesis and really promise to founders has been from the start that Ankona not only has this unique investment strategy we can talk about, but as investors, we're a unique marriage of experienced software investors and experienced software operators. So the investors are myself and Josh Harmson, who came from Solus Capital, buyout background, just great at what he does. And the two other partners I recruited started as investors in the fund, became operating partners, and then agreed to step up as full-time general partners. Two Orange County-based founders, Jared Smith and Nuth Morris. Jared started a company called Avetta, grew it to 60 million in revenue and sold it, raised money from Norwest along the way. And Nuth Morris was one of the co-founders of Telligis, grew that to about 100 million in revenue and sold it to Verizon. So we were able to replicate, you know, part of what was key to our initial thesis, which is, you know, the right team includes people who have invested and people who have actually done it. And, you know, we'll go through our philosophy on approaching investments, but we think that makes us more empathetic. And, you know, we've been there, and it does seem to resonate with founders.
Yeah, no, exactly. So Nuth, I know I think Jared too, but I know Nuth is pretty active with the CoFund as well. So, you know, for those of you that listen, we had Paul Boyce on our podcast about a month and a half ago. And so Nuth is part of the investment committee there, I believe, and very active in the CoFund. So yeah, you certainly through Nuth and Jared, I believe, really kind of grabbed the Southern California or the Orange County angle there. So that's good. As a homer, that's good for us.
It's great. I mean, and I think we're very well connected in Orange County, and I think we're doing a good job also connecting opportunities to groups like CoFund and Okapi and other early stage investors.
Sure.
So it's working really well.
Okay.
We've also added 3 operating partners to the team on top of the 4 full-timers who are all software company founders.
And I think may add some more people to the team at some point, I believe. Is that what are your thoughts there?
Our goal is to hire an associate in Q1.
Okay. Yeah, probably dependent also kind of on the fundraising and how it goes. I mean, that's the other challenging part about starting a new fund is until you make those first close, until you get to a size, it just the economics don't work to add as many people as you'd like to add. It'd be wonderful to, you know, build out a full-blown team right from the start, but just like a software company, you know, until you start to get to those things, you've got to build the team with the money you have.
That's right.
So yeah,
limited pool of management fees to build a team and build a firm, and it is it's hard.
Yeah. So your website has done a really nice job, I think, and I really encourage people to go there, anconacap.com. But to talk about kind of the way you view, say, your convictions, kind of what you guys believe as a firm. So, and you list 4 of those, and I'd like to kind of start with the first 2. So you talk about rational financing rounds and flexible structures. And we actually, I think one of the questions in there, Karen, I see your question in there. We'll touch on that one soon. And Vincent, we'll touch on your question because they're asking about what does capital efficient growth mean and what kind of exit opportunities do you like? So I think we'll cover them all there. So why don't we start with those first two? What do you, rational financing rounds and flexible structures, what does that mean to founders and to startups out there in SaaS companies?
Yeah, this is really, that page that you're looking at is really our pitch to founders. And this is based on, you know, what we've heard and how we can sell Ankona to founders, because all these founders do have choices. And, you know, our view of financing rounds is that a lot of funds have to write bigger checks than these founders want to take. And, you know, they're writing checks, you know, really dictated by the size of the funds that they're managing, not by the needs of the business. You know, we had a follow-on financing in one of our existing portfolio companies where we were able to negotiate every term, valuation, every term, but the new fund would not negotiate on the minimum size of the check. They would not write a check less than $50 million, and the deal would blow out. They'd negotiate everything else, but not that. So our pitch to founders is, and these are all sort of connected, you know, don't take too much money. Makes everything much more difficult, you know, forces you to pursue growth that might not be smart and capital efficient, takes exit optionality off the table. So all those points on this page are really related. And on the flexibility, you know, there are a lot of firms that are really looking only for bootstrap businesses that don't work well with existing investor syndicates. You know, we work very well with existing venture investors. And this is partially a function of the fact that we're really only comfortable writing a $5 million check. There's plenty of room for insiders to participate. We're also less threatening in a lot of ways to existing syndicates. If you're a seed or Series A investor who's been in a company for 5 years, bringing on a new $20 or $30 million investor just means there's a new sheriff in town. And we're just a little bit more copacetic. We're a little bit more aligned with the interests of the smaller funds. So we've found situations where we're just a better fit,
Okay. So Kieran asked the question, which is right in line with your other two convictions, capital efficient growth. So why don't you define, what does capital efficient mean in terms of B2B SaaS companies?
Yeah, so when we're investing in a company, Ankona means elbow in Greek. So we talk about investing in companies at the elbow. We don't really use that language anymore, but it's pertinent to this question. Companies at this stage are going through a lot of growing pains. They're growing up. They're going from startup to scale. And typically in earlier stage companies, you sell to anybody. Anybody will buy the product you will sell to. But at some point, growth efficiency and SaaS metrics really start to matter, especially to the later stage investors. The later stage investors don't have much patience for metrics that don't look the way that they want to look. So a core part of what we do is to look at the business by segment and really tease out ideal customers versus not ideal, and to steer the business over time to those better customers, which enables more capital efficient growth. So we favor slower, smarter growth over growth at any costs. And it is becoming a little bit more popular, but that's not historically been the venture capitalist approach, where you're sort of growing at any cost. That's not what we want to do. And, you know, related to one of the other points in here, preserving exit optionality, it's just good.
Yeah.
It's good to be able to sell the company for a couple $100 million and to have a life-changing event for the founder and to make the entire cap table happen. And if you raise too much money because you've been too capital inefficient to get there, that door's closed. It's closed. So, you know, we favor a more incremental approach to growth, smarter growth, focusing on the right customers, and not overcapitalizing, so you preserve the option of early liquidity.
Okay. So that early liquidity then probably says you're open to that optionality, you're open to those things. So not necessarily driving towards multi-billion-dollar unicorn IPOs or things like that.
No, I mean, we're not averse to a multi-billion-dollar unicorn exit, but the reality is that's just not the path for most companies. And we're very focused, I described earlier, on opportunities that we can get to scale and profitability. Scale's 30 to 50 million in revenue and profitability. And the thesis there is if you can get there, the world's your oyster. You can keep growing organically, you can raise a follow-on round, and that's big enough to appeal to a big range of strategic and financial buyers. So that's where we want to get. And at that point, the founders and the investors can make a decision, go big, sell, and we're pragmatic. This is not on our website, but we underwrite to a 3 to 5x return in 3 to 5 years. So we, if we get some big hits, that's great. And some of our investments actually look like they're breaking that way, but we don't want to bet on that when we're making the investment. So we're looking for opportunities where we can see organic growth that gets us to that kind of multiple in our time horizon.
Okay, yeah, that's good to know. So tell us about while we're kind of digging into the firm and how you operate, tell us about the process that you and your team use to evaluate companies. How does it work, kind of start to finish? What should those founders expect out of your process? And what are some of the things that drive that decision making? And when it comes right down to it, how actually do you guys decide to pull the trigger on an investment?
Yeah, we try to be efficient. We're very fast to no. I think we should be faster to yes, but we try to be efficient and transparent. The way the process typically works is whoever gets referred to the investment, and they can come from anywhere. If it's an in-profile investment opportunity, I'll reply to a LinkedIn message, as long as whoever's sent the message knows that it's something based on what's on our website we should be interested in. But typically we'll do a 30-minute initial call, and I will take a 30-minute initial call with any Southern California-based SaaS company, even if it's not yet even if it's too early for us. Part of what we want to be is the go-to fund for any SaaS company in Southern California. So we'll take those calls and build relationships, and we'll typically make intros for companies that are too small for us. But the typical process is 30-minute initial call. Most things, that's it. And we'll provide the feedback right there. We have partner meetings twice a week, so we can discuss as a team. And then typically the first full pitch, that first 30-minute call is typically just a get to know you. Here's how we approach things, and here's what we look for, sort of pre-qualification, move from a marketing qualified lead to a sales qualified lead if you're in startup world. And we'll get a deal team on it. So the first full pitch will be more than one Ankona team member, and we'll discuss it at the next partner meeting. So within a week and a half of first contact, we'll know if we're digging into diligence or not. And diligence takes a longer period of time. Preliminary diligence is usually at least a couple weeks, and usually just involves digesting whatever materials the company has in the data room. And then deeper diligence, we are very hypothesis driven. So from then we will send our list of issues, things that we got to believe to build conviction, and things that we see, right and wrong. And we have our own SaaS metrics worksheets. We will put everything into our format, so that we are really comparing apples to apples in the way that we're evaluating the metrics. And that's, frankly, a month or two overall, because we're also very focused on, and it's hard with COVID, getting to know the team and the culture. We are minority investors, but we're very active in everything that we do. And we have to believe that we are going to get along with the founder. It's a marriage. And that personal conviction takes time to develop.
And you also have some thoughts about what makes, and this probably goes back to what you mentioned at McKinsey. You have some thoughts about what types of culture you like to see at the portfolio companies you invest in. So since you just said that's part of what you'd like to dig into, what do you like to find? What turns you off?
Yeah, I mean, there's a lot of talk now about diversity. To me, that's always been a part of what defines companies with winning cultures. I mean, our companies they win awards for great places to work, great CEOs, great cultures, great places to work for women, all that. And the competition for talent is so intense and is so critical to the success of these companies that it's one of the main things we look at. If you were to see our internal processes, culture is 20% of what we look at out of everything. And if you look at some of our portfolio companies, and there's a lot on their cultures, they're remarkable places. They're inclusive, they're diverse, they support a lot of different lifestyles now in terms of working, practices. great benefits, focus on health and wealth, everything that you want to see. And, it's not charity. This is what it takes to build a company that's going to succeed and win. It's just the facts. So we spend a lot of time focused on the CEO's ability to build that culture and the company's embodiment of those kinds of values that we think are important for a company to succeed.
Yeah, a tangential question that came in here, because you're looking at the organization, you're looking at the culture of the organization. So solo founders versus kind of founder teams.
Yeah.
That's a challenge. It's good to have founder teams, but then you can have founder disagreements, and that can blow things up versus solo founders. So I wouldn't have thought of that, but someone asked the question, so I thought I'd throw it out there.
Yeah, we're typically investing when the executive team is pretty well fleshed out already, so well beyond that. But yeah, for founders, I think it's, regardless of what investors think of investing in a solo founder company, that's just lonely. I mean, it's just, from having started Ankona, it was my partners that kept me sane. I wouldn't want to start something by myself.
Yeah.
I wouldn't want to do it. It's lonely. It's hard. There's ups and downs. When I'm down, I need somebody else to bring me up.
Yeah, and listen, I believe the data shows that as well, right? So there have been some amazing partnerships that have grown to be pretty amazing. So I think management research also shows that. So why don't you let's go ahead before we get too far. Well, we're pretty far into it. Before we run out of time, tell us a little bit about the investments that you guys have made. So what are some of the companies in Ancona's portfolio company?
So we made four investments since the fund was started. We're hoping to make our fifth in Q4, and we are actively looking for investment opportunities. The key for us to build a successful firm is to continue to build a team and to continue to build a good portfolio. So we need to put money to work. The first investment we did is one called Zingle in San Diego, and great example of exit optionality. The founder had a couple of personal setbacks, not unlike the ones that I faced, and was tired and was able to, had an offer to sell the company, and it was a life-changing event for him, and took 5 quarters from the time we invested to the time we sold, but was a good outcome. And they were, thank goodness we got that one sold. They were selling to hospitality clients, so they'd have had a really rough go of COVID. So
Ankona Fund 1 has had its first exit?
We were an SP. We did that as an SPV, so that's technically not a fund. But the following 3 are in the fund. The one that got our fund going was a company called Video Amp, and Video Amp is in Santa Monica, and they help buyers and sellers of video advertising understand very precise demographic data of who's viewing videos across all platforms. So they unify over-the-top linear broadcast, digital, walled gardens, everything to provide audience profiles and viewing habits across channels. And so they're helping big brands dramatically improve the efficiency of their ad campaigns. And this is the one that we had at the start. It's what got our fund closed, and it's the one that went on to raise $50 million after we invested from a group called the Rain Group. That's in Santa Monica. Sochi in San Diego is a social media management platform for multi-location businesses. That's one where we came in as $5 million with insiders doing the rest, and it has just done great through COVID. And that's one where we've also really come to understand how these larger growth equity firms work. A lot of the growth equity firms that were not interested the last time around are really interested this time around. Now that the company's above 20 million in revenue, they're thinking about a bigger round, and most importantly, the work that we do on segmenting and focus, we knew looking at their business that there was a segment of customers they had that were going to churn out, and it was impacting their overall numbers. But we could see what was going to happen. In a year, we bleed them all out, and the numbers would look great. The bigger firms were not willing to take that bet. So now that it's gone as we thought, they're focusing on the good customers, letting the bad ones bleed out. The numbers look better, and everybody's interested in in the company.
Nice, nice. And a couple of weeks ago, Paul Boyce from CoFund brought up Gosight, and that's one of your portfolio companies too. So Paul told us a little bit about Gosight, but for those of the audience that don't recall or weren't on the thing, tell us a little bit about Gosight, but more importantly, tell us, how you guys were able to, kind of take the baton from there.
So I actually met Alex from Gosight years ago, before Cove made the investment, just as part of the work to get to know founders. But Cove made the investment, so my partner Nuth, who you mentioned is involved with Cove, sat on the board. So we had a board seat at Gosight since prior to this round. So we had an opportunity to come into the round that was led by Longley, and we took it. It was another situation where the company has just, Alex is a remarkable young CEO building a really unique culture in a really crowded space, but where he's been able to really keep growing and drive. And it's a combination of the way that they're approaching sales and marketing and their product vision. And so it's all just coming along. And we had a chance to see how they performed through COVID, which we liked, and they adapted and performed. They changed their marketing to focus on regions that weren't shut down. So they stopped selling to, businesses in Manhattan. They went to businesses in, Idaho, and they kept selling.
Just keep rotating to the green spots, I guess, on the map.
It's such a big market. SMB, I mean, there are hundreds of thousands of potential customers, and very underpenetrated. So they just shifted the focus, and we're able to keep growing. So we're excited about that one.
Good. One of our watcher attendees posted a question that was right on my list, so it's awesome. So from where you stand, kind of at the Series B, what do you like to see? What would you want to see in terms of the funding universe for seed and Series A? What works so that it can grow to where you guys are? Maybe what doesn't work, and frankly, everybody does seem to be moving upstream a little bit. So where are the funding gaps that you see them? So talk about the earlier part from where you guys don't involve. What makes it a good target to grow into you guys, et cetera?
Yeah, so we are, and we're still very focused on Southern California. We're starting to look at Nevada and Utah and some other markets, but I think the Southern California early stage ecosystem is pretty well developed. There are a lot of really good seed and Series A funds, and I know that companies that go through Crosscut or a Mucker or some of these, they're going to emerge to look the way that we want them to look. It does become more challenging. In an ideal world, a lot of investors use a 1-to-1 funds raised to ARR ratio. Ideally, you get the 5 to 7 million of ARR on 5 to 7 million of capital invested. It doesn't always work out that way. But by the time we see a company, we want to see that that company has identified a vein of gold, ideally very focused on a particular customer, a particular need in a particular vertical, where they've proven an ability to sell software and to drive good net retention numbers that are indicative of being worth an investment in growth. So that's what we look for. And the team, we are primarily backing founders. We're debating whether we preserve that model or would be willing to do something where we're bringing in somebody. But for the most part, we're looking for founders, again, who have built that. And founders are really the ones to build the kind of culture we like. We're looking for founders. The teams are usually 70 to 80% done, maybe with 1 or 2 gaps, and they're ready to roll. They know if we invest 10 to 15 million, they know where the money is going to go. The marketing machine probably isn't fully tuned, but there's enough there that we know that we can get predictable growth. We expect our companies to hit their forecasts, which is different than what a lot of early venture. We expect to be investing in companies that have a good shot at hitting their forecasts. So we'll dig into quota attainment and what are the assumptions around this growth and how are we ramping sales. So we expect companies to hit their revenue forecasts.
Right. And you're actively involved to get them to do that. So that's great. Anything else? We're kind of 10 minutes out. Anything else about Ankona that we haven't covered?
No, I think we got it. I mean, we're stoked to be in business. We're right off of, right next to Fashion Island, right in the heart of Newport Beach. I live in San Diego. My original dream was building a firm in San Diego, but everybody else is up there, so I lost out on that bet.
Yeah.
But we're excited. You know, we got a long ways to go. But what we've seen, I think what our approach is resonating with founders. You know, we've got to keep working on that, and we've got to keep getting ourselves in front of the best local founders. And again, a core part of that strategy is to get to know founders early and to be helpful to them so that by the time they are ready for us, we're one of the first calls. So we want to be active parts of the Southern California ecosystem.
And listen, I think you're of the 14 of these that I've done, you're the first person that's been able to say, and listen, this would have been a dream for me 20 years ago, that you are looking to hire an analyst or associate. I'm sorry.
I don't know. Probably associate. I mean, I'm not sure.
Yeah, a junior person. You're looking to hire a junior person. So if there's anybody in the audience that is interested, or anybody in the audience that knows somebody that wants to get in there. So yeah, of all types, I think you've got a great lead here.
Q1 for the new hire. So if anybody wants to, anybody can send me an email. It's fine, but we're going to punt till Q1. I can't get my other partners to engage in me sooner than that.
I hear you. As we said before, there's got to be the economics to be able to support that. Hey, within B2B SaaS, where you guys are there any specific markets or technologies that you're interested in right now? If you had to pick a few hot spots.
You know, I think mostly what describes a typical Ankona investment is one that's just relatively focused. So we do a lot of vertical SaaS. We've done a lot in MarTech. I think we're a little overexposed to MarTech. Some of the ones that I'm most interested in now are interesting. I wouldn't call them fintech, but they're more financial oriented. But there's a ton of interesting stuff in Southern California. We finished a market scan of SoCal, and I want to say I looked at 1,500 software companies, which, believe it or not, exist in Southern California. And there are 175 that I think are really, really interesting and that we're actively tracking. So there are a lot of companies here in Southern California that are perfect fits for us, but they tend to be local. I mean, they tend to be focused, somewhat vertical, capital efficient, with uniquely talented founders. We stay away from enterprise security, data center automation, big horizontal platform plays, the kinds of things that really are the domain of the big, unicorn chasing venture funds.
Right. And obviously getting back to, we've touched on it before, but getting back to looking for those teams with good cultures, with diverse cultures, with it that have that diversity there as well. And hopefully as your team continues to grow, it will grow kind of in those areas as well. So we hope so. Okay, listen.
It's hard to do that. I mean, there's an incredible fight for talent in my industry right now. It's not easy.
Yeah, no, I've seen that. I've following some folks that I know at LinkedIn, or that I'm related to on LinkedIn. I've seen a lot of moving around kind of in some of those positions right now. It's clear that a lot of firms are looking to kind of hire in that direction. So I've seen that as well. So okay, cool. I think we've covered a lot of these questions that we have here. One of the things that I'm a big believer in is that only good things happen when you finish early. So I'm a believer in that. So I think we can probably start to wrap things up here. Let me bring up our slides again. So as we're kind of wrapping things up, here's some information. And so Brian's information is on there. We talked a lot about his website. I would really encourage everybody to go to the website, anconacap.com, and read about a lot of the things they've put up there. It's a good thing to really understand both what Ankona is trying to do, and they put a lot of thought into that. It'll help you kind of figure out how you want to kind of create your founder culture as well. And there's Brian's LinkedIn information. He said he answers LinkedIn messages. So if you want to reach out to him, kind of put something on there. Brian, you can validate that. Hopefully you didn't. I don't think you popped off, Brian. I don't see it on there, but.
I'm sorry.
Good. So, and then also, definitely want to thank Kenobi Martins again, a unique intersection of technical intelligence and legal acumen for a world powered by innovation. We're thrilled that Kenobi has been able to sponsor this webinar series, and we think it's worked out well for all of us. We do have our next one scheduled. So we're going to be talking to Sanjay Reddy from Unlock Ventures, and that's going to be 2 weeks from today. So I'm not sure. Hey, Travis, who is our guy, yes, he just put up in the chat box, he put in a link that you can use to register for it. If you want to just go ahead and click on that and register for that, you can listen to us in a couple of weeks. And I think that'll be all. There's maybe a couple questions there left in the chat. So Brian and I will hang around a little bit, maybe answer a few of those. But otherwise, everyone, thank you for tuning in. Stay safe and have a great weekend.